Hello, this is Quent Bilo. In this session, we're looking at the slides for Chapter 2, the recording process. Important to the study objectives of this chapter is learning the meaning of debits and credits, the language of accounting, recording journal entries, formal journal entries in a set of books called the journal, transfer the information to another set of books called the ledger, and pulling off reports out of the ledger. As we can see, an account is the place at which we collect financial information. It records either increases or decreases in specific asset accounts, specific liability accounts, and specific equity category accounts, such as revenue accounts, expense accounts. We also have a drawing account. There is an owner's capital account, which is increased for investments made by the owner. All accounts can be expressed in a T account diagram as shown on the bottom here. Every account will have a name to it. It'll have a left side called debit and a credit or right side. The meanings of debit and credit mean as indicated. Debit means left, credit means right. You should not pour other meanings into that term other than left and right. Accounting uses a double entry accounting system such that every transaction that's recorded has a dual effect on the equation. At least two accounts are affected, sometimes more, but at least two. And the dollars declared in accounts in terms of debits and the dollars declared in terms of credit dollars must equal each other to maintain the equality of the various components of the equation. If debit values flowing into account are greater than credit values during a period of time, we call that an account a debit account. All normal assets are debit accounts because we expect the debit entries to exceed the credit entries. Likewise, if credit entries coming in exceed debit entries, that account will have a credit balance, and we call that an account a credit account. All payables accounts are credit accounts. All revenue accounts are credit accounts. The owner's capital account is a credit account. Here we have a diagram that shows the T accounts for assets in general and liabilities in general. Assets will increase on the left-hand side or debit side. Remember that assets appear on the left-hand side of our equation. They increase on the left-hand side of their accounts. Liabilities are a claim that appears on the right-hand side of our accounting equation. Liabilities increase on the right-hand side or credit side of the account. So the normal balance of a liability is a credit. The normal balance of an asset is a debit balance. Owner's equity account. There is an owner's capital account shown at the bottom that increases with credits that will reflect investments that owners bring to the business. As assets increase on the left-hand side of the equation, we will credit the owner's capital account in a dual entry to mirror that increase in assets. Owner's drawing accounts, we say that they increase with the debit. That has the effect, though, of decreasing the equity category. Revenue accounts increase on the right-hand side with a credit. We say expense accounts increase on their debit left side. Expense accounts are part of owner's equity, and therefore as they are debited, it has again the effect of reducing the equity category as expenses are increased. Overall view at the normal balance of accounts. Assets would normally have a debit balance. Expenses will have a debit balance. Liabilities a credit balance, normal balance. Owner's equity with the capital account will have a credit normal balance, as is all revenues. Again, expense accounts fall under the equity category. They're just shown on the left-hand side here because of the normal debit balance, but they are a owner equity account. As expenses are increased with debits, it has the effect of reducing the overall owner's equity or net worth position. Assets are increased with debits. Expenses are also increased with debits, but expenses appear on the right-hand side of the accounting equation. They belong to the equity category. Again, a debit to an expense account has the effect of reducing the equity category value. Likewise, debits will decrease liabilities. They'll decrease any equity account. They'll decrease revenue accounts. We normally do not have debit values in revenue accounts except at year-end during certain special closing procedures, which we'll look at in another chapter. Credit entries are just the opposite of debits. So as assets increase with debits, they will decrease with credits. Likewise, liability, equity, revenue accounts will increase with credit entries. And expenses will decrease with the credit entry, again, only at year-end in special closing entries. The normal balance to the accounts indicated are shown in blue. Assets debit, liabilities credit, equity such as owner's capital credit, revenue credit. Expense accounts will normally have a debit balance. So what do debits do? They increase assets and decrease liabilities. Each category is on different sides of the equation, and therefore the debit has a different effect on each side of the equation. Accounts that normally have debit balances. Asset accounts, the owner's drawing account, and the owner's expense accounts. Again, the latter two are under the equity category on the right-hand side of the equation. As those accounts are debited, that indicates that assets have gone down on the left-hand side, reflecting a decrease in the owner's equity by debiting the owner's drawing or expense account. An overview of the accounting category, basic equation on the top and an expanded one at the bottom, expanded due to the owner's equity category. As we can see, owner's equity has 4 different activities that are measured through it. In the owner's capital account, we'll measure increases to investments the owner has made. As they bring in assets, we'll increase the owner's capital account with a credit. Assets are debited on the left as an increase. As owners withdraw money, assets are reduced with a credit on the left, and we will debit the owner's drawing account on the right, which has the effect of reducing the owner's equity category value on the right-hand side. Revenues, as cash sales or credit sales are made, we increase cash or accounts receivable on the left, assets, and we give credit to the owner's equity revenue category on the right. As expenses are funded, assets are reduced on the left-hand side of the equation with credit, and we debit the expense account on the right. Again, that debit to the expense account on the right-hand side has the effect of reducing the owner's equity category. We can record expenses before cash flows. Under that circumstance, we would recognize expense with a debit entry, and we would recognize a liability to be paid later with a credit entry. So we can record expenses before cash flows. It's called accrual accounting and is a common occurrence in businesses. But for every debit entry in a journal entry that occurs, there must be a credit entry to maintain the equality of the balance sheet, of the accounting equation as shown. So I'll recap. Debit means left. Asset accounts on the left-hand side are increased with debits. Credit means right. Liability accounts on the right-hand side of the equation are increased with credits. Likewise, the equity category on the right-hand side of the equation is increased with credits. So we have a sea of debits on the left that increase assets, equaling an ocean of credits on the right-hand side. In effect, we can say that credits on the right-hand side claim. Positive numbers on the right-hand side have a positive claim on assets on the left. It's best to focus on the increase side, that is, assets up with debits, all claims on the right, whether they be creditor liability claims or owner equity claims, increase with credits. Decreases are just the opposite. Assets are reduced with credits, and claims by creditors or owners are reduced with debit values. In Chapter 1, we used a table approach to show the effects of recording transactions on the equation. In Chapter 2, we'll introduce two separate books. This is the normal approach. We will record transactions in a journal, transactions by date sequence or chronological sequence, and then we'll duplicate that same information into a ledger set of books, which is classified by account, classified under the categories of asset, liability, or owner equity. So two sets of books here, same information, data is just ordered differently. The ledger, the second set, is much better suited to prepare reports since accounts are classified by their accounting element category. Let's look at the journal first. It's called the Book of Original Entry. It's like a diary. Transactions are recorded in chronological order. Again, transactions are economic events that affect financial condition. That is, they're recorded because they affect either an asset position, a liability claim position, or an owner equity claim position. Here's an example of a formal journal entry. We have two transactions here. On September 1st, the owner, Ray Neal, invested $15,000 cash in the business, and on that same date, the business, SoftBite, purchased computer equipment for $7,000 cash. So let's record both entries. They're independent. They just share the September 1st date. So on September 1st, cash increases. Assets are increased with debit, so we'll debit the cash account. And the second account affected owner's capital. We'll indent that into the right, and the credit column to the right indicates an increase in the owner's capital with a credit of $15,000. So we have our debit entry of $15,000 equaling our credit entry declared at $15,000. End of journal entry. Same day, we bought equipment. What happened? Assets went up. So we debit assets $7,000. The source of that purchase was use of cash. So we used cash, or it decreased, therefore we will credit our cash account. The second entry is an example of simply a rearrangement of assets. Equipment goes up, cash goes down. Nothing changes on the other right-hand side of the equation because we have not changed assets in total. Another transaction on July 1st. Butler Company purchases a truck costing $14,000. Now it finances this part by paying cash immediately and agreeing to pay the rest on account. So the supplier is granting us credit here when we purchase this. What happens? Assets went up by $14,000. We acquired the equipment, historical cost, funded by a reduction in cash or a credit of $8,000, and also funded by the supplier's credit. So we maintain an account and accounts payable to that supplier, $6,000 credit. Again, total $14,000 in debits equals total $14,000 credit entries. This is known as a compound entry that is, use of more than two accounts. An overview of the general ledger, which includes all the accounts maintained by a company, individual asset accounts, cash, supplies, land, equipment. The characteristic here is that assets are recorded because they have future economic value or benefit to the company. Other side of the equation, liability accounts, accounts payable, notes payable, salaries payable, interest payable, and others. 99% of liability accounts enter the word payable, indicating that we have recorded a legal debt or obligation of the business. Owner equity accounts, we have a capital account which books investments by the owner, a drawing account which records divestments by the owner. As cash goes down, let's say we will decrease cash and will increase the drawing account. The drawing account increase has the effect of reducing the owner's equity category. Service revenue accounts increase with credits. Salary expense accounts or any expense account increase with debit, which has the effect of reducing owner's equity accounts. The owner's net worth is increased with credits. That credit, overall credit balance we would like to see in the owner's equity account means there's a positive claim on assets on the other side of the equation. Here's a standard form of an account. We have a cash account title. Every account has a numerical numbering system, in this case 101. Here we see a series of transactions, June 1st through the 30th, various entries of changes to cash. These entries came from journals, and we simply transfer the data into the ledger. Did you see the T account in that ledger? Debit left, credit right, left side, debit side, right side, credit side. For cash, we'd expect there to be a preponderance of debit entries and have a debit balance, therefore. Cash would be a debit account. Here's an example of posting, another word that simply means transfer. Transfer information from the journal set of books to the ledger set of books. Here, use of the reference column in the respective journals and ledger indicate that information has been transferred. The journal at the top, cash has a debit of $15,000. We transfer that to the general ledger as a debit entry, left-hand side of the account, and we indicate in the ledger that it's from J1 of the journal. In the journal, we indicate in the reference column 101 that the information is going to the ledger account 101. In a manual system, journals would be transferred or posted to the ledger on a daily basis, if not after each transaction. In computerized systems, as journals are created and they're entered or recorded to the journal, they're automatically transferred to the ledger. Here the owner's capital at the journal entry, $15,000 credit. We show it entered in the credit column of the owner's capital account. And again, the cross-reference going to account 306 in the journal. The ledger owner's capital says it comes from J1 page in the journal. In case there's any examination of the ledger and more detail is needed, we know which journal page to go back to see specifics of the individual transaction that was journalized. Posting, simply a transfer of journal entries to ledger accounts. Separate books in a sense that contain the same information in different sequence. Journal, date sequence, ledger, accounts by equation category. Here's an overview of the chart of accounts of a business, Pioneer Advertising Agency, showing a typical numbering system. Numbering systems can vary by company. This is just an example. So we have asset accounts, liability accounts, various owner equity accounts, which include owner's capital and drawing, revenue accounts, and expense accounts. The income summary account you see under the owner's equity category, we'll address that in another chapter. It's only used at year end. The color coding here, the red accounts simply will indicate we'll have sample journal entries to these accounts in the coming pages. Okay, illustrating the recording process, that is the journal recording process and the subsequent transfer into the ledger. On October 1st, C.R. Bird, the owner, invests $10,000 cash in his company called Pioneer Advertising Agency. First of all, we analyze what's occurring here. Cash is increasing, and the owner's equity or net worth category is increasing by $10,000. So in our equation analysis, out of our Chapter 1 format, we would increase cash plus $10,000. On the other side of the equation, increase owner's equity in the owner's capital account $10,000. Chapter 2 here, the debit and credit analysis indicates that we know that if assets increase, they increase with debits. As the owner's capital account increases, it increases with credits. And so the formal journal entry, this is Chapter 2, increase cash $10,000 with the entry to the debit column, the left-hand side of the T account, increase owner's capital on the right-hand side or credit side. The only thing missing from this illustration is the fact that the column debit and credit could have been labeled in this example. And then the entry from the journal is transferred to the ledger. Cash, $10,000 on the left-hand side, debit side, owner's capital, $10,000 credit entry to complete the recording of this transaction. Another sample transaction, October 1st, the company purchases office equipment by signing a note. So they're not acquiring this by cash, they're acquiring this on credit. So our analysis, equation analysis, assets will go up by $5,000 and so will liabilities, indicating a current obligation to be paid later. So we increase equipment with a debit entry, $5,000, increase notes payable, a liability account with a $5,000 credit. Debits equal credits in all journal entries. The bottom indicates the transfer of that information into the ledger. Debit column for equipment, meaning an increase. Credit column for notes payable, meaning an increase there. Each of those accounts are on different sides of the equation. Another transaction, the company receives a $1,200 cash advance from a client, a customer. So our customer is paying us in advance before services have been performed. This can occur. What's occurring here? Cash is increased, $1,200, but it's not an earned service revenue. We'll increase an unearned service revenue account, which is not a regular service revenue account, but it's a liability account. If we'd go out of business the next day, we'd have to return that money to our customer, and we have it already recorded as a liability, so that would not be an issue. Entry, debit cash, $1,200. Credit unearned service revenue, $1,200. Again, a liability account, not a regular service revenue account. The term revenue means inflow of assets due to the sales process. The sales process here, though, is not complete because we have not delivered service to the customer. In this transaction, the company Pioneer pays office rent. This is a cash expenditure, a cash expense. We want to reduce cash and also reduce the owner's equity by $900. And so our journal entry is to debit the rent expense account. That's an account under owner's equity, so that has the effect of reducing owner's equity, and credit the cash account, an asset account which has the effect of reducing cash. Down below we see the entry posted along with other information from previous transactions. So cash is building up a debit balance here, and at this point rent expense only has one entry into it, a debit balance of $900. Here's an example of the company paying $600 for a one-year insurance policy that will expire on September of the next year. The fact that we're prepaying our insurance means that all the insurance periods covered are not yet lapsed or expired, and so therefore we're acquiring an asset. We're going to decrease cash, and we're going to increase another asset called prepaid insurance. Debit to prepaid insurance, increasing an asset, credit to cash. That's the way it was funded. We'll see in other parts of this chapter that at month end and subsequent month ends, we'll transfer a portion of that prepaid insurance out of prepaid insurance with a credit and into the owner's equity insurance expense account with a debit as the insurance is effectively consumed. Expenses can be thought of as consumed assets. Here we have an example of acquiring supplies, an asset, an item of future value, on account, meaning that we haven't paid for it in cash, but we've incurred an obligation. And so we're going to increase our asset account with a debit to our supply account. And a credit to accounts payable of $2,500. Here's an important event, hiring key employees. In this case here, we're hiring an employee to start later in the month. At the time we hire them, it's not a transaction that's recorded. It has no effect on the financial condition of the business. No change in assets, no change in liability position, no change in owner equity position. Therefore, no journal entry is recorded. This transaction, see our bird owner, he withdraws $500 for personal use. He's removing assets from the corporation. Cash is going to go down $500 and will reduce the owner's equity position or net worth position by $500. We'll record that decrease in owner's equity by debiting an account under owner's equity called owner's drawing, and we'll decrease cash with a credit. Again, we see several entries that have built up in cash. There's still an excess of debits over credits, the normal balance we'd expect in asset accounts. No balance is yet shown in this ledger, though. This transaction, the company is paying salary expense, reducing cash by $4,000 and reducing owner's equity by $4,000 by use of an expense account, salary and wages expense. I'm going to debit salary and wages expense for $4,000, increasing the expense account, which has the effect of reducing owner's equity, and crediting cash, which has the effect of reducing the cash account under the asset category. This transaction, the company receives $10,000 cash for advertising services provided. This is a sale activity, a cash sale activity. This is why the financial reason the business is in operation, to make sales. So we're going to increase cash, an asset, with a debit, and explain that with an increase in service revenue on the right-hand side with a credit. The right-hand side of the accounting equation is always explaining why assets have changed on the left, either up or down. At month end, companies will pull what's called a trial balance. This is simply a listing of all accounts in the ledger and their respective month-end balance. In this case, the excess of debit entries to credit entries in cash was $15,200 balance in the cash account. Trial balances are assembled to ensure an equality of debits and credits, that no gross error has occurred in either recording journal entries or transferring those amounts into the ledger. In this case here, we have debits of $28,700 equaling total credits of $28,700. At this point, we have no reason to suspect any errors have been made in recording transactions. Although we should note that a balanced trial balance does not mean that all transactions were recorded correctly, just that the debits and credits declared were in balance. Limitations of a trial balance. Trial balance will not balance if we record a cash withdrawal at one amount different than the amount we debit the owner's drawing account. That would be an error. It would be detected by a trial balance imbalance. In summary, IFRS, International Financial Reporting Standards, is a group headquartered out of London, which issues, in effect, international standards. GAAP is issued by the Financial Accounting Standards Board in the U.S. These two bodies are converging their principles so that in the coming years there will likely be one set of international financial standards that companies will use. Despite some differences between international standards and U.S. standards right now, they all use double entry accounting. That is the basis of accounting systems worldwide, as indicated. U.S. companies primarily use historical cost to record the acquisition of assets, and it stays at historical cost. European countries allow some increases to the value of those assets to be booked over time. That's one of the differences between international and U.S. standards at this time. Both use the same process for recording transactions. Trial balance is the same under international financial reporting standards and U.S. GAAP.